Hey, I'm Steven and this is Solving the Money Problem. If you're new, welcome. If you're not, welcome back. So in today's video, we're going inside the mind of a Tesla short seller and ex-billionaire. Shorting Tesla stock will do that to you. David Einhorn. Einhorn's hedge fund, Greenlight Capital, has produced suboptimal returns for an extended period of time now, predominantly because poor old Einhorn appears to be a value investor stuck in the 1970s who is simply unable to understand growth stocks. Einhorn's hedge fund has just posted an update sharing their most recent thoughts around Tesla stock and the company's insane valuation. So in this video, we'll dive into Greenlight's latest thoughts around Tesla stock and the company's valuation, and we'll also wind the clock back as early as 2017 to see if there's been some consistency in Einhorn's thoughts around the company and whether or not any new information has changed his investment thesis. So let's get into the video. But first, hey guys, if you live in the US and you'd like to help out the channel and get up to 4 free stocks, check out the link in the description to WeBull. If you open a new account, you'll get 2 free stocks between $2.50 and $250 each just for opening an account. And if you deposit $100, you'll get a further 2 free stocks valued between $8 and $1,600 each. That is an obnoxiously good return on your investment. I mean, really, deposit $100 and you'll end up with, at minimum, $21 worth of stocks, a 21% ROI on your money. And if you're in Australia, the UK, or New Zealand, you can get a free stock with stake also using the link in the description. Let's get back to it. So allow me to set the scene. It's 2019. David Einhorn is speaking at the Sohn Investment Conference, and he takes an opportunity to mock and ridicule Elon Musk's very ambitious timelines, showcasing some slides with quotes from Elon Musk regarding promises about ramping production, profitability, full self-driving, etc. Now, as we know, Elon Musk always does what he says he does, but sometimes he's late. Hey, what's wrong with being a little bit optimistic on your timelines? However, I'm going to take the opportunity to completely roast David Einhorn using his own technique. This will all make sense in a moment, so grab your popcorn and enjoy the show.
Napoleon once said, "Never interrupt your enemy when he's making a mistake." So I won't. Just watch the screen.
Einhorn says Tesla's gain during the quarter made the portfolio's second biggest loser, even as he says the company's fundamentals continue to deteriorate.
Another terrible month for hedge fund billionaire David Einhorn, so bad that some of his investors are jumping ship. Leslie Picker is here with more. Leslie, what's going on here?
Has Einhorn gotten redemptions recently? Absolutely. That's according to a person familiar with the matter. Will those redemptions continue? Most likely until he begins to really turn things around.
I mean, how much commitment do you have to have as a long short investor? When you go short on something like Tesla, that can get pretty painful.
Yeah, look, Tesla is one of, many things we have in what we call our bubble basket of stocks that we just think are mispriced, and they're mispriced by huge amounts.
A real culprit is his so-called bubble basket of shorts, with names like Netflix and Amazon, which have soared. The firm declined to comment when asked about performance and redemptions.
And, they're sized in a way that gives us the ability to, wait a fair amount of time to be proven right or wrong. I think eventually the mood of the market will change. Eventually the company will be called into account to demonstrate profitability. I don't know when that will happen, and the portfolio is positioned properly relative to the risk and the reward there.
Another disappointing quarter for Einhorn, with losses of more than 5% for the year. His Greenlight Capital down more than 18%.
Is money leaving Einhorn's fund?
Oh yeah, and he even pointed out the redemptions in the letter, saying that I understand why you are redeeming. However, he does believe that his portfolio as it's currently constructed is poised to profit in the long run. So in the investor letter, Einhorn called Elon Musk, quote, erratic and desperate, highlighting examples like when Musk said on an analyst call that the analyst was asking boring, bonehead questions. Einhorn also said he wouldn't renew his Model 3 lease. This morning, Musk fired back on Twitter saying, tragic. We'll send Einhorn a box of short shorts to comfort him through this difficult time. Give you some examples given the numbers and performance as of lately. Take, for example, the month of June. Greenlight was down a whopping 7.7%. In the year through June, the losses were nearly 19%. That marks dramatic underperformance relative to the S&P 500 over those time frames. Greenlight also trailed the benchmark during both 2017 and 2016.
Manufacturing problems continued, yet the stock jumped after the CEO promised the short burn of the century on Twitter. Despite short-term production surge theatrics, the company has missed all of its material manufacturing targets and financial projections. Losses at the company are mounting.
We had in a prominent auto analyst from Morgan Stanley just the day before yesterday. And in talking to him about the relative value of Tesla on the one hand and General Motors on the other, he said, if you gave me $20 billion to give to either Elon Musk or Mary Barra, I would give it to Elon Musk because there's more growth there. Yeah, that was his response.
Yeah.
So what's your response to that question? Because you have a short position on Tesla at the same time you're proposing this for General Motors.
Yeah, I think it's a question of what the purpose of the $20 billion is. If the purpose of the $20 billion is to earn a profit and a return on the $20 billion, I think you would give it to Mary Barra because GM is interested in its return on capital. They're trying to make about a 20% return on its invested capital, and that's a wonderful return on $20 billion to the extent that they were able to deploy it. I think if the purpose of a business is to advance the future, to have science experiments and really cool, buzzwordy kind of things, then you would give it to Tesla. Because there you have a guy who's done all kinds of fancy innovation and is thinking about how society should be 50 years from now, 100 years from now, but he's yet to actually take any money and turn it into a profitable business. And I don't have any optimism that that will change.
Well, you may be right. We'll find out about Tesla.
God, that was painful to watch. Sorry, David. Didn't want to interrupt you there, my friend. So before we get to Einhorn's latest thoughts around Tesla stock, I just want to point out a couple of things there just to sort of summarize what we saw. I just can't not mention that Einhorn's the guy was simultaneously short Netflix, Amazon and Tesla. I mean, god damn, dude. If that alone isn't an indication that you're just out of your depth and you don't understand growth stocks, growth companies, and you just should give up, I really don't know what is. But anyway, the man persists. So I think if I were to sum up Einhorn's thinking, or lack thereof, around Tesla stock, it would boil down to this. Tesla is losing money and their losses are mounting, and I don't ever see them becoming profitable. If they do turn a profit, that would surprise me. Hey, David, a couple of years later, Tesla now 5 consecutive quarterly profits in a row, about to report their 6th, just saying. And what appeared to be an astonishing moment of cognitive dissonance there, Einhorn freely admitting that Elon Musk is very innovative, future-focused, really changing the world, yet you'd be much better off giving $20 billion to GM if you actually want a return on that capital. Now, I do not know a nice way to say this, but that is just one of the dumbest things that I've ever heard anybody say, period. I really mean that. Now, it's nothing personal against David, right? I'm sure he's a well-meaning guy, but if that's where the thinking genuinely was, that he genuinely believed that he'd see a better ROI on that capital, giving $20 billion to GM, than to Tesla, than to Elon Musk, you just have to have rocks in your head. I'm sorry, but how else do you say it? So now that Tesla is a cash flow positive, highly profitable money printing machine, let's see the most recent thoughts from Einhorn's Greenlight Capital. Here we are looking at Greenlight Capital's latest letter to investors. I quote, "We also managed to sidestep most of the significant second half rally in Tesla as we adjusted our position ahead of its inclusion in the S&P 500 index. Jumping in here, that was probably a wise decision. Even so, Tesla was our largest loser in 2020, with most of the losses coming in the first half of the year. I have to jump in here once again. It's been a number of years where Einhorn's hedge fund have been betting against Tesla stock. It hasn't worked out. At what point do you take a step back and ask yourself the question, hang on a minute, are we wrong? Or is the entire stock market wrong? Just saying. Tesla cars are not a fad. If they were, Tesla would sell many more than it does. Okay, whatever. The fad is in owning Tesla stock. We have quipped before that twice a silly stock price is not twice as silly, it's still just silly. But what about 20 times a silly price? In the 2000 internet bubble, Cisco Systems peaked at our 29 times revenue, which would be a discount to where Tesla now trades. This begs the question as to why a stock might trade at 20 times a silly price. Of course, there is the possibility that we are just wrong and bad at measuring silliness. I have to jump in here. David, mate, just between friends, you are wrong, dude. Like, dead fucking wrong. Stop shorting Tesla stock. Stop betting against Elon Musk. It's not going to work out. It never would have, and it never will. It's not a smart idea, dude. Just go sit in the corner and think of a better decision. Make that decision instead, because shorting Tesla, betting against Elon Musk is never a good idea. But setting that aside, we think that the answer is that certain stocks are held exclusively by valuation indifferent investors. In our early training, one of the first concepts we learned is market capitalization, or the share price times the number of shares outstanding. This is what a company is worth in the market today. Valuation analysis means comparing the market capitalization to various indications of value. It might be a comparison to current and future revenues, earning, cash flows, asset values, etc. When we speak of valuation indifferent investors, we mean investors for whom valuation is not part of the process. They either will not, cannot, or choose not to consider valuation as a factor. Will not. Index funds are the most obvious valuation indifferent investors. In fact, to the extent a stock is overvalued, index funds are required to buy even more of it. Passive investing has become so prevalent that passive index investors are no longer price takers, buying at the prevailing price set by active investors engaging in a vigorous effort to determine the correct value, but rather price makers. Their demand sets the price. From our perspective, price making rather than price taking calls into question the entire premise of passive investing. Now, this is a fair point. Index funds aren't making decisions as to whether or not to invest in a company based on this metric or that metric. They just need to weight their index based on the valuation of the company that the market has determined. So, totally fair point. Cannot. A second group of valuation indifferent investors are the new masses of retail investors who simply have no training or competency in valuation. Historically, their influence has been limited by stockbrokers or financial advisors who determine suitability and provide advice. Today, no advice or suitability is needed. Download an app and start trading commission free. Log on to the app and it will give you a free share in a highly speculative stock to get you going. Many in this group think an expensive stock is one that trades at $100 a share and a cheap stock is one that trades at $5 a share. There is a grain of truth to this. There's many retail investors out there who wouldn't even know how to read a balance sheet, let alone understand companies' market capitalization, what valuation means, none of that stuff. But here's an extremely controversial point. 5 years ago, in 2016, if you had the following: a functioning brain and a lack of preconceptions and biases blinding you to reality, I think you could have made a better investment decision in a company like Tesla by avoiding all of the spreadsheets, all the financials, fuck valuations, fuck PE ratios, fuck all that garbage. If the only research you did into this company before investing was to watch every single interview Elon Musk has ever done, every earnings call, everything, every word he's ever spoken publicly on the internet, if you watched all of those interviews, those videos, etc., you would have understood the character, the intellect, the determination, and the vision of this man and had confidence enough to invest in this company. And I'm not suggesting that you should just watch videos from a CEO and that's how you decide whether or not to invest in a company. I'm just making a point of how completely fucking useless and misguided traditional valuation metrics are when trying to understand disruptive, innovative companies. The catastrophic error of judgment made by practically every single short seller of Tesla stock is that they're blinded by their own biases and misconceptions. Instead of taking a big picture look at the company, understanding the fact that the cost of their core technologies are consistently and predictably declining over time, the fact that economies of scale plus declining costs will automatically expand their market, all sorts of other things, I've been over this a million times, guys, you get the whole spiel. The point is, if you're a traditional value investor, and instead of trying to take a first principles look at this company and understand what's their mission, their vision, their leadership, instead, if you go, oh my God, they're not making enough money, they're going to go bankrupt, I don't like it, it doesn't fit into the box on my spreadsheet, what do I do with this company, I don't understand. You're prone to make bad investment decisions and look like a moron in the future. Now, I really need to sort of shake the tree here on value investing. It's dead, guys, okay? Value investing is dead. We're in the age of technological innovation and disruption. Have you noticed the world's changing a lot? Like a lot? Remember how you used to buy DVDs and Blu-rays and CDs and records and tapes and now you don't even buy them anymore? Remember how you used to buy physical books and now you can download them instantly in audio format or on your Kindle? Do you remember how things are changing really rapidly? Yeah, value investing applied to the old world where things didn't change a whole lot in a short amount of time. We're no longer in that world. You guys need to wake up and get with the times, or like David Einhorn, you're going to be losing your shirt and your short shorts and practically everything else as well. Now, I just want to make a distinction here. There's many investors out there who will prematurely dismiss an opportunity, pass up on investing in that company. I get it. I do the same thing myself. There's only so much time in the day. It is what it is. I'm not judging. That's fine. Here's where I take issue. When you have the hubris and arrogance to think you've identified a company that's destined to fail, that's overvalued, that makes no sense, and you haven't dug deep enough, you're projecting your own biases, your own thoughts and opinions, rather than looking and taking a first principles approach to the company and trying to understand what's going on. This is what every single Tesla short seller has done. This is the major error and mistake that they've made. They've misunderstood the company. They've misunderstood everything about them. For example, Tesla's going to go bankrupt. They can't make any money. No fuckface. They're investing in future scale and growth. They've told us that. They've told us their mission. Like, value investor, instead of listening to Tesla's reasoning and understanding that they're investing capital, R&D, capex, future growth and expansion, scale, blah, 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 blah. You know, they're trying to transition the world off fossil fuels. It seems like 100% of Tesla short sellers were short on grey matter before making their decision to short the company. Now, I don't know, maybe I'm crazy, but let's just imagine that me, some random guy on YouTube, here's a company say, we plan to do this. This involves making products, getting them to scale, driving the cost down, getting them to more customers, continuing to drive the cost down until everyone's buying these products. Now, if I was a smart investor, I would take a step back and ask myself the question, if this company does actually plan on achieving their stated goals, what actions would they be taking? Are those actions the same actions we're seeing being taken now? For example, investing heavily in R&D and scaling production. Wait, they are taking those actions now? So they are moving towards their mission. Is there a problem here? Let me check my spreadsheet. Choose not to. A third group of valuation indifferent investors are professional investors who have decided that valuation is not part of the process. As Howard Marks described in his recent memo, Something of Value, the attitude is to hold as long as the thesis is right and the trend is upward. This investor group thinks it's unproductive to consider if the market capitalization exceeds even the best case estimates of the present value of future earnings by an order of magnitude. I just want to point out the fact that I think many Tesla short sellers, many Tesla bears, have mistakenly looked at Tesla and thought, spreadsheet says they're an automotive company, and if their valuation is to make sense, they would need to sell more cars than everyone else on the planet combined. These same folks have failed to consider the software revenue, robo-taxis, energy, batteries, solar, auto-bidder software, completely discounting this entire part of the business, then drawing the conclusion that Tesla can never grow into the valuation, therefore, let's short Tesla stock. I think a major part of this comes down again to the preconceptions. Instead of thinking, reasoning, first principles, ground up analysis, it's like, if they do that, they're going to be like the biggest company in the world ever. What does the spreadsheet say about that? Spreadsheet says that's not possible. Okay, short Tesla stock. This goes far beyond buying growth at a reasonable price or even growth at any price. It takes the traditional vice of letting your winners run to its logical extreme. When the last holder of a stock that has a valuation as part of the process exits and the shares are held more or less exclusively by members of these groups, the stock becomes disconnected from fair value. Valuation becomes irrelevant and the stock price itself may well be a random number. The only point in observing that various money-losing companies, without any proprietary advantage, I just gotta jump in here, come on dude, are you fucking kidding me? You sound like Bob Lutz in 2017, 2018. Tesla has no technological advantages, Tesla has no advantages whatsoever. Anyway, let's move on. Are trading at valuations that imply that they will someday become industry leaders is to marvel at just how speculative the bubble in disconnected stocks has become. Many of the favourable dynamics that helped our long portfolio in the fourth quarter led to losses in the short portfolio. The moral of this story, guys, is quite simple. There has never been a good reason to short Tesla stock, yet many people confidently did exactly that and have suffered catastrophic losses as a result of their poor decision making. Every single person who lost enormous sums of money being completely fucking wrong about Tesla was completely fucking wrong about Tesla because they didn't look deep enough. They reasoned by analogy rather than first principles. Instead of actually looking at Tesla, the company, their technology, the competitive landscape, etc., they looked at GM and then looked at Tesla and thought, oh, hang on a minute. That doesn't make sense. Short Tesla. The key lesson from this is quite simple. Many people, many investors over the years will pass up on great investment opportunities, misunderstand companies, misjudge them, mischaracterize them. Totally fine. If you pass up on an investment opportunity, you were wrong about it, but you didn't invest, you didn't short the stock, who cares? Here's where there's a major problem. When you actively make an investment decision, whether you're going long a stock, you believe in the company, you're very bullish, or on the flip side, you're very bearish and you decide to short a stock, you really better know what the fuck you are doing. You really better know the company, the leadership, the technology, the competitive landscape. You really better have done a lot of thinking before you put your money on the line. And in the case of David Einhorn and many of the other Tesla short sellers, while they mean well, these folks live in spreadsheet land. They do not understand what they're looking at, yet they're too arrogant or blinded by their own biases to even recognize this fact. David Einhorn, if you're watching, please dude, don't bet against Elon. There's a reason our Don't Bet Against Elon t-shirt is the second best-selling design in the merch store. By the way, link in the description if you'd like to get your own. It's just great advice. We all make mistakes. It's part of life. But guys, seriously, in 2030, Tesla will be delivering over 20 million vehicles per year. They will have an energy business about the same size as the automotive business. People will be using Tesla robotaxis to move from point A to point B. Tesla, the company, will be generating over $1 trillion of annual revenue. What then? Does the stock really look overvalued today when you take that into account? Of course not. But none of these numbnuts shorting Tesla stock today actually think that's the path they're on. Well, we'll just have to wait and see, won't we? And before we wrap up, guys, since we're talking about investment mistakes, what's the biggest mistake you've made when it comes to investing? Was there a company you misunderstood, you shorted the stock, turned out to be a bad idea? Was there a company you invested in, turned out that wasn't such a bright idea? Let me know in the comments below what's your biggest investing mistake and what did you learn from it? I'm Stephen Mark Ryan, this is Solving the Money Problem, and I love you all. And don't forget, if you live in the US and you'd like to help out the channel and get up to 4 free stocks, check out the link in the description to WeBull. If you open a new account, you'll get 2 free stocks between $2.50 and $250 each just for opening an account. And if you deposit $100, you'll get a further 2 free stocks valued between $8 and $1,600 each. And if you're in Australia, the UK or New Zealand, you can get a free stock with stake also using the link in the description. Thanks so much for watching. Let me know your thoughts in the comments below. And of course, if you have any ideas for future videos, let me know. I read all your comments. PS, if you're still watching, you're awesome. If you'd like early access, exclusive videos, regular Q&As, our private Discord server and more, consider supporting the channel at patreon.com/solvingthemoneyproblem so I can keep creating content for you guys. There's a link in the description. You can now also become a member of the channel for some exclusive perks. To learn more, click the join button next to subscribe. And don't forget to check out our merch store. Either way, the best form of support is you being here and watching, so thanks again.